The content in this video is for educational and informational purposes only and should not be considered financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Any past performance or case studies shown in this presentation are not indicative of future results. You've felt it before, haven't you? That feeling of holding a trade, watching the chart for hours, your stomach in knots. You're waiting for that big move, the one you read about, the one the experts on TV predicted. You're holding through the news announcement, hoping it goes your way. But instead, a single headline, a single piece of data from the other side of the world, vaporizes your position in a heartbeat. It feels like you're playing a game where someone else knows all the rules, and you're just a step behind, constantly reacting to a market that feels chaotic and unpredictable. You've tried swing trading, you've tried position trading, but the long waits and the overnight risks are exhausting. What if there was a different way? A way to approach the markets that doesn't rely on predicting the next big geopolitical event or the Federal Reserve's long-term policy. A method that focuses purely on the here and now, on the rhythm of the market, in and out, sometimes in less time than it takes to make a cup of coffee. This is the world of Forex scalping. And over the next 10 parts, we are going to pull back the curtain and dissect this high-speed discipline, specifically for you, the US-based trader. Forget everything you think you know. This isn't about gambling or frantic, random clicking. This is a craft. It's about precision, discipline, and understanding the very heartbeat of the market on a tick-by-tick basis. We're going to break down the strategies, the tools, and most importantly, the mindset required to navigate the fastest-moving sessions in the world, the London and New York markets. By the end of this series, you won't just know what scalping is. You will understand the mechanics behind it, how to identify potential setups, and how to build a framework for approaching the market with a completely new perspective. So, what exactly is scalping? Let's strip it down to its core. Imagine two predators in the wild. You have the eagle, which soars high above, patiently waiting for hours, maybe even days, for that one perfect opportunity to dive and catch a large meal. That's like a position trader. Then you have the hummingbird. It doesn't wait for one big score. It zips from flower to flower, taking tiny sips of nectar from dozens, even hundreds of sources throughout the day. By the end of the day, that hummingbird is just as fed as the eagle, but its method was entirely different. It relied on frequency and speed, not size. That hummingbird is a scalper. A Forex scalper aims to take small, consistent profits from tiny price movements over and over again. We're not trying to catch the entire day's trend. We're not trying to predict where the euro will be next week. We are concerned with the next 5 pips, the next 10 pips that are available right now. We get in, we hit our small target, and we get out. The entire process can last for a few minutes, or in some cases, less than 60 seconds. Now this sounds exciting, and it is, but it's also one of the most misunderstood forms of trading. The internet is filled with myths. People think it's about having lightning-fast reflexes and staring at 16 monitors like a scene out of a Hollywood movie. That's not the reality. The reality is that scalping is a game of probability and execution. It's about identifying high-probability patterns that repeat themselves day in and day out, and then having the discipline to execute your plan flawlessly without emotion. For the US trader, this is particularly relevant. Why? Because you operate at the epicenter of global market volatility. The most lucrative time for a scalper is when there is high liquidity and strong movement. This happens when major market sessions overlap. The absolute prime time is the overlap between the London session and the New York session, which typically runs from 8 a.m. to 12 p.m. Eastern Time. During these 4 hours, you have the two largest financial centers in the world fully active. Trillions of dollars are changing hands. Banks, institutions, and hedge funds are all making their moves. This creates the clean, fast-paced price action that a scalper thrives on. We're not interested in the slow, sleepy Asian session. We want the fireworks of the New York Open, and as a US-based trader, that happens right in your backyard. This series is designed to give you a roadmap through that volatility. We'll focus on major pairs that are most active during these US hours, like the euro versus the US dollar, the British pound versus the US dollar, and the US dollar versus the Japanese yen. These pairs offer the tight spreads and the consistent volume that are absolutely critical for a scalping strategy to even be viable. Trying to scalp an exotic, thinly traded currency pair is like trying to be a hummingbird in a desert. There's just not enough nectar to survive. But before we even look at a single chart pattern or a technical indicator, we have to talk about the most important element, the mindset. Scalping is a psychological battle more than anything else. Because you're dealing with such a high volume of trades, you cannot get emotionally attached to any single one. A swing trader might take one loss in a week and have time to recover emotionally. A scalper might take 5 small losses in an hour. If you let each one of those losses affect you, you'll be mentally wiped out before the New York session even hits its stride. You have to learn to view losses not as failures, but as a business expense. They are a necessary part of the process. The goal isn't to win every single trade, that's impossible. The goal is to have your small wins collectively outweigh your small, controlled losses. This requires a level of emotional detachment that most people aren't prepared for. You must be decisive, disciplined, and able to pull the trigger without hesitation, but also able to cut a losing trade instantly without a second thought. There is no room for hope in scalping. Hope is the enemy. There is only your strategy and your execution. So, how do we build that strategy? It rests on 3 core pillars, and we will dedicate entire sections of this series to each one. The first pillar is understanding market structure. This is about reading the tape, understanding order flow, and identifying where the major banks and institutions are likely to be buying and selling. It's about seeing the market not as a random squiggly line, but as an auction, a constant battle between buyers and sellers, and learning to position yourself on the winning side of that battle, even if it's just for a few moments. The second pillar is your toolkit. This involves selecting the right charting platforms, the right broker with low latency and tight spreads, and a very small select group of technical indicators. Many new traders make the mistake of cluttering their charts with dozens of indicators, creating what's known as analysis paralysis. A scalper's chart needs to be clean, simple, and built for speed. We'll explore a few simple, powerful concepts like moving averages, price action patterns, and volume analysis that can help you make split-second decisions with clarity. The third, and arguably the most important pillar, is rock-solid risk management. This is the foundation upon which everything else is built. Without it, even the best strategy in the world will ultimately fail. For a scalper, this means defining your exact risk on every single trade before you enter. It means using a strict stop-loss and never, ever moving it further away from your entry. It means understanding position sizing down to the dollar. In scalping, you're not looking for home runs. You're hitting singles. And the key to winning a baseball game with singles is to never get thrown out trying to stretch one into a double. Your risk management rules are what keep you in the game long enough for your strategy's edge to play out. This is not a path to overnight riches. This is a skill, and like any valuable skill, it takes time, practice, and a tremendous amount of discipline to develop. What this series offers is a structured, no-hype introduction to the principles of Forex scalping, tailored for the unique opportunities presented by the U.S. market sessions. We're going to build your understanding from the ground up, starting with the very DNA of price movement itself. Because before you can extract profits from the market in minutes, you have to first understand the fundamental forces that move it, tick by tick. And that fundamental force, the concept of liquidity and order flow, is precisely where we are headed next. So let's dive right into the heart of the market. Imagine you're standing in the middle of the world's largest, most chaotic auction house. There are thousands of people all screaming, all trying to buy and sell the exact same thing at the same time. Some are whispering orders for a few dollars, while others are shouting orders for millions. This chaotic, overwhelming, yet incredibly efficient system is the Forex market. And the lifeblood, the very air that everyone in that room is breathing, is called liquidity. Liquidity, in its simplest form, is the ability to buy or sell something quickly without causing a massive price swing. Think about selling a 2023 Toyota Camry versus selling a rare, one-of-a-kind classic car. You can sell that Camry in a day, probably at a price very close to what you're asking. Why? Because there are thousands of buyers and sellers for Camrys. The market is deep. It's liquid. Now try selling that classic car. It might take months to find the right buyer, and the final price could be wildly different from your initial asking price. That market is illiquid. In Forex, the euro to US dollar pair is that Toyota Camry. It's the most traded currency pair in the world. At any given second, there are billions of dollars worth of orders waiting to be bought and sold. This high liquidity is a scalper's paradise, and it's critical for three specific reasons. First, tight spreads. The spread is the tiny difference between the buy price and the sell price. It's the commission you pay to your broker for the privilege of placing a trade. In a highly liquid market like euro to US dollar, there's so much competition between buyers and sellers that this gap becomes razor thin, sometimes less than a single pip. As a scalper, your goal is to make maybe 5, 8, or 10 pips of profit on a trade. If the spread is 3 pips wide, you're already starting the race 30 or 40% behind. You need that spread to be as close to zero as possible, and only high liquidity can give you that. Second, reduce slippage. Slippage is a trader's nightmare. It's when you click buy at a certain price, but by the time your order travels to the server and gets filled, the price has already moved against you. You get filled at a worse price than you intended. In a liquid market, there are so many orders stacked up at every single price level that your order is far more likely to be absorbed instantly at the price you want. And in a liquid market, your order can be the one that literally moves the price, causing significant slippage and turning a potential winning trade into a loser before it even begins. And third, execution speed. Scalping is a game of milliseconds. You need to get in and out of the market with surgical precision. High liquidity means there's always someone on the other side ready to take your trade instantly. You click the button and you're in. You click it again and you're out. There's no delay, no waiting. This is non-negotiable for a scalper. So, liquidity is the condition of the market. It's the environment we need to operate in. But what creates this environment? That brings us to the second half of this puzzle. Order flow. If liquidity is the water in the ocean, order flow is the current. It's the force that actually moves the price. Price doesn't go up because of a magic line on a chart or because a pattern looks nice. Price goes up for one reason and one reason only. There are more aggressive buy orders hitting the market than sell orders. And it goes down when the sellers are more aggressive than the buyers. That's it. That's the entire game. Order flow is the real-time, unfiltered story of this battle. It's the sum total of every single buy and sell decision made by every participant in the market. From a student trading with $100 in their dorm room to a central bank executing a multi-billion-dollar order. Imagine a giant tug of war. The rope is the current market price. On one side, you have all the buyers pulling the rope trying to drag the price higher. On the other side, you have all the sellers pulling it lower. The price moves based on which side is pulling harder at any given moment. Order flow analysis is like having a direct view of how many people are on each team and how hard they are pulling. It's about seeing the raw strength of the buyers versus the sellers. Now, who are the most important players in this tug of war? It's not us, the retail traders. We are tiny plankton in this ocean. The real sharks, the ones whose movements create the massive currents we want to follow, are the institutional players, the big banks, hedge funds, and multinational corporations. They are the ones moving hundreds of millions, even billions of dollars. When they need to buy or sell, their orders are so large they can't just click a button like we do. Doing so would cause massive slippage and alert the entire market to their intentions. Instead, they have to be more clever. They break their large orders into smaller pieces, or they place massive passive orders at specific price levels, waiting for the market to come to them. These huge orders create what we call liquidity pools. For example, if a major European bank needs to buy 1 billion euros against the US dollar, they might place a huge limit order to buy at, say, the 1.0800 level. This level now becomes a massive wall of support. It would take an incredible amount of selling pressure to chew through that $1 billion buy order and push the price lower. As scalpers, our job is not to fight these sharks. Our job is to identify where they are feeding and swim alongside them. We're trying to spot their footprints in the market. When we see evidence of a huge institutional buyer stepping in, we want to buy right alongside them, riding their wave for a few pips, and then getting out before the water gets choppy again. So how do we see these footprints? How do we actually analyze order flow? This isn't something you can see on a standard candlestick chart. You need specialized tools that let you look inside the candles. The first tool is the depth of market, or DOM. You might also hear it called the price ladder, or level 2 data. This is a live, real-time view of all the pending buy and sell limit orders waiting to be executed at different price levels. It literally shows you the order book. You can see, for example, that there are $50 million waiting to buy at one price level and only $10 million waiting to sell at the level just above it. This gives you a clue about potential short-term support and resistance. It's like seeing the battle lines being drawn before the fight even starts. The second tool is the time and sales, often just called the tape. This is a running log of every single trade that is actually executed. It shows the price, the volume of the trade, and whether it was a buyer or a seller who initiated it. While the DOM shows you the intention to buy or sell, the tape shows you the action. It's the proof. Watching the tape allows you to see if large, aggressive orders are hitting the market, signaling that momentum is picking up. Finally, a more advanced concept is the volume profile. A standard volume indicator on your chart shows you how much was traded during a period of time, like a 5-minute candle. The volume profile flips this on its side. It shows you how much volume was traded at each specific price level over a certain period. This is incredibly powerful because it highlights the prices where the most business has been done. These high-volume areas often act as powerful magnets for price, representing a fair value area or a point of control where buyers and sellers have reached a temporary equilibrium. By combining these tools, a scalper starts to see a three-dimensional picture of the market. They aren't just seeing a green candle. They're seeing the DOM showing weak seller interest above, they're seeing the tape printing a rapid succession of large green buy orders, and they're seeing the volume profile indicating they are moving away from a high-volume area. This confluence of information provides a much higher conviction reason to enter a trade than a simple line crossing another line. This is a fundamental shift in perspective. It's moving from being a passive observer of price history to an active analyst of the forces creating price in real time. It's about understanding the why behind the price movement, not just the what. And for a scalper, who lives and dies in the tick-by-tick noise of the market, this understanding is paramount. Now, having this deep understanding of the market's mechanics is one thing, but it's useless if you're trying to apply it at the wrong time of day. The market's liquidity and order flow have a distinct rhythm, a pulse that beats differently depending on the time. Certain hours are chaotic and flush with volume, perfect for scalping. Other hours are quiet, stagnant, and dangerous. So now that we know what we're looking for, our next step is to pinpoint when and where to find it. And that means dissecting the major Forex trading sessions and identifying the specific, high-probability windows that are most favorable for scalpers operating in the US. The global foreign exchange market is a 24-hour beast, a relentless river of capital that never truly sleeps. But here's a secret that separates novice traders from seasoned professionals. Not all hours are created equal. While the market is technically always open from Sunday evening to Friday afternoon in the US, the real opportunities for a scalper are concentrated in specific, explosive windows of time. Think of it less like a steady river and more like a tidal system, with periods of calm, shallow water and periods of powerful, surging tides. As scalpers, we aren't interested in drifting. We're looking for those powerful waves of volatility and liquidity. And to find them, we need to understand the three great kingdoms of the Forex world: the Tokyo, London, and New York sessions. Let's start with the first session to open the global business day. The Tokyo session, also known as the Asian session, running roughly from 7 p.m. to 4 a.m. Eastern Standard Time. This session is often characterized by a more subdued and cautious tone compared to what follows. The major players are Japan, Australia, New Zealand, and China. Consequently, you'll often see more movement in currency pairs involving their respective currencies, like the Australian dollar versus the US dollar, or the US dollar versus the Japanese yen. For US-based traders, especially those on the East Coast, the Tokyo session happens overnight. It can sometimes be a period of consolidation, where prices trade within a relatively tight range after the previous day's New York close. While major economic news from Japan or Australia can certainly inject volatility, it's generally considered the quietest of the three main sessions. For scalpers, this lower volatility can be a double-edged sword. On one hand, breakouts can be less frequent. On the other, range-bound strategies might find some application here. But for most US scalpers seeking high-velocity moves, the Tokyo session is often the prelude, the calm before the storm. Then as Asia begins to wind down, the storm arrives. The London session, kicking off around 3 a.m. Eastern Standard Time and running until noon, is the undisputed heavyweight champion of the Forex world. London is the planet's largest and most important financial center. When its traders get to their desks, the market's entire personality changes. Volume explodes. Liquidity floods in. The sleepy, range-bound movements of the late Asian session are often shattered by a surge of activity. This is because a massive percentage of all Forex transactions happen during London hours. Major European economic data is released, big banks and institutional players execute their largest orders, and the market's true volatility for the day is often established. For a scalper, the London session is a target-rich environment. Spreads on major currency pairs like the euro/US dollar, and the British pound/US dollar tend to tighten due to the immense liquidity, which lowers transaction costs, a critical factor for a high-frequency strategy like scalping. The sheer momentum and number of participants create the fast-paced environment where scalping can thrive. The London Open, right around 3 a.m. Eastern Standard Time, is particularly notorious for its sharp, decisive moves. For dedicated U.S. traders, especially those on the West Coast where 3 a.m. Eastern Standard Time is a more manageable midnight, this can be a key window of opportunity. But the real magic, the absolute prime time for a U.S.-based scalper, happens when the two biggest players are on the field at the same time. This brings us to the New York session, which opens at 8 a.m. Eastern Standard Time and closes at 5 p.m. By itself, the New York session is a powerhouse. It's the second largest Forex market, and when U.S. traders come online, they bring a massive amount of capital and economic influence. Major U.S. economic news, like the non-farm payroll report, inflation data, or Federal Reserve announcements, are released during this session, and they can send shockwaves across every single currency pair. However, the most critical period of the entire 24-hour cycle is the overlap between the London and New York sessions. From 8 a.m. to 12 p.m. Eastern Standard Time, the two largest financial centers in the world are operating simultaneously. This 4-hour window is what many professional scalpers live for. It is the moment of maximum liquidity, maximum volume, and often maximum volatility. It's like having two Super Bowl-winning quarterbacks on the field at once. The market is awash with capital from both Europe and North America. The largest banks, hedge funds, and corporations are all active, executing massive trades. What does this mean for you, the scalper? First, spreads are typically at their absolute tightest. The sheer volume of buyers and sellers creates an incredibly efficient market, reducing the cost of entering and exiting trades. For a strategy that relies on capturing small profits repeatedly, this is a huge advantage. Second, the volatility provides a steady stream of trading opportunities. The price action is rarely stagnant. The confluence of European news winding down and major U.S. news being released can create sustained trends and powerful, fast-moving breakouts. This is the high tide we were talking about. During this London-New York overlap, the major pairs, Euro to US dollar, Pound sterling to US dollar to Japanese yen, and US dollar to Swiss franc, are at their most active. The market is moving, and for a scalper, a moving market is a working market. Thinking about this from a practical standpoint for a US trader is key. If you are on the East Coast, this golden window from 8 a.m. to noon falls perfectly in your morning. You can trade during the most liquid and volatile part of the day, and still be done by lunchtime. If you're on the West Coast, this window is from 5 a.m. to 9 a.m. An early start, but it means you're trading in the absolute best market conditions before the rest of your day even begins. Understanding this timing allows you to structure your life and your trading plan for maximum efficiency. Instead of trying to watch the charts 24/7, you can focus your energy and attention on these specific high-probability windows. You're not just trading harder, you're trading smarter. After 12 p.m. Eastern Standard Time, London traders start heading home, and the London session officially closes. You'll often notice a distinct drop in volatility and volume in the U.S. afternoon. The market can become choppier, less directional, while opportunities can still exist, especially if there's late-day news out of the U.S. or Canada. The peak conditions for scalping have generally passed. The market transitions from the high-energy overlap into the more singular focus of the late New York session, before it eventually hands the baton back to the quiet of the Tokyo session, and the cycle begins anew. So, the first pillar of our scalping framework is now in place. It's not just about what you trade, but when you trade. We've moved from a vague 24-hour market to a precise, 4-hour window of peak opportunity, supported by the slightly less volatile, but still potent, hours of the main London and New York sessions. Your job as a developing scalper is to align your personal schedule with these market sessions. Acknowledge when the market is most likely to provide the volatility you need, and when it's likely to be quiet. Trying to force trades during the slow, late afternoon or overnight hours is often a recipe for frustration, characterized by wider spreads and unpredictable, choppy price action. Instead, by focusing your efforts on the London Open and, most importantly, the London-New York overlap, you are placing yourself in the path of the highest probability for movement. You are positioning yourself to ride the waves, not to get stuck in the shallows. So we have our prime hunting hours established. But just because the market is open and active doesn't mean every minute is a trading opportunity. Inside these volatile windows, the market moves in distinct patterns, breathing in and out, trending and consolidating. The next challenge is learning to read the language of the charts in real time to identify the precise moments of strength and weakness that signal a potential scalping entry. We need to know what a high probability setup actually looks like on a 1-minute or 5-minute chart. And that means diving into the world of technical indicators, specifically tailored for the high-speed demands of scalping. So let's build your scalper's toolkit. Think of the 1-minute chart as a chaotic, fast-moving river. Trying to navigate it with just your eyes is a recipe for disaster. You need instruments. You need a compass, a depth finder, and a speed gauge. Technical indicators are those instruments. But here's the critical part. For scalping, you can't use the same slow, clunky indicators that a long-term investor would. You need tools built for speed and precision. We're going to focus on a combination of 3 types of indicators that, when used together, can provide a much clearer picture of what's happening in these frantic timeframes. We're looking for trend, momentum, and volume. Get those 3 aligned and you start to shift the odds in your favor. Let's start with the absolute foundation: trend direction. Even on a 1-minute chart, price moves in tiny trends. Your first job as a scalper is to identify the direction of that micro-trend and trade with it. Fighting the immediate current is a losing game. The most common tool for this is the moving average. But not just any moving average. Many traders start with the simple moving average, or SMA. But for scalping, it's often too slow. It gives equal weight to all the price data in its calculation period, making it lag behind rapid price changes. We need something more responsive. Enter the exponential moving average, or EMA. The EMA gives more weight to the most recent price data. It hugs the price action more tightly, reacting quicker to shifts in direction. For a scalper, that speed is everything. A very common setup you'll see scalpers use is a 2 EMA combination. Think of it like having a short-term and a slightly longer-term compass needle on your chart. For example, a trader might use a 9-period EMA and a 21-period EMA. The 9 EMA is the speedboat. It zips around, showing you the absolute immediate momentum. The 21 EMA is more like a steady cruiser. It shows the underlying, more established microtrend. So how do we use them? The core concept is the crossover. When the faster EMA, the 9, crosses above the slower EMA, the 21, it's often interpreted as a bullish signal. The immediate momentum is accelerating faster than the recent trend, suggesting a potential move upwards. Conversely, when the 9 EMA crosses below the 21 EMA, it's seen as a bearish signal, suggesting downward momentum is building. But a scalper doesn't just trade every crossover blindly. That would be chaotic. Instead, you use the EMAs to define your bias. If the price is consistently trading above both the 9 and 21 EMAs, and the 9 is above the 21, your world is bullish. You are only looking for buy entries. You ignore the sell signals. If the price is trading below both EMAs, and the 9 is below the 21, your world is bearish. You are only looking for sell entries. This simple filter instantly cuts out half of the bad trades you might be tempted to take. The EMAs become your dynamic support and resistance. In an uptrend, you might watch for the price to pull back and touch the 9 or 21 EMA, treating that as a potential area to enter a long position, anticipating a bounce. Okay, so we have our compass. We know the direction of the current. But what about the force of that current? Is it speeding up or slowing down? That's a question of momentum, and for that we need a different tool. This brings us to our second piece of kit, the oscillator. One of the most popular oscillators for scalping is the stochastic oscillator. Now, that sounds complicated, but the concept is simple. It measures the current price relative to its high-low range over a certain period. Essentially, it's asking, is the current closing price near the top of its recent range, or near the bottom? The output is a value between 0 and 100. Readings above 80 are generally considered overbought, and readings below 20 are considered oversold. Here is where so many new traders get it wrong. They see overbought, and they immediately think sell. They see oversold and they think buy. That's a massive mistake, especially in scalping. In a strong uptrend, the stochastic can stay overbought for a very long time as the price keeps pushing higher. It's not a reversal signal. It's a confirmation of strong bullish momentum. So how does a scalper use it? By combining it with the EMAs. Remember our rule? If the EMAs tell us we're in an uptrend, we are only looking for buys. So we ignore the overbought signals from the stochastic. Instead, we wait for the price to pull back, and we watch for the stochastic to dip down into the oversold area below 20. When it then starts to cross back up out of that oversold zone, while the price is still respecting our bullish EMA structure, that becomes a point of interest. It's a signal that the temporary pullback might be losing steam, and the original upward momentum could be about to resume. Think about it. The EMA say the overall microtrend is up. The price pulls back, giving you a better entry price. The stochastic confirms that the pullback is potentially exhausted. You have trend and momentum aligning. This is a much higher probability setup than just trading a random crossover. Now for the third and final piece of our core toolkit. We have trend direction from the EMAs. We have momentum from the stochastic. But is there any real conviction behind the move? Is this a genuine push by big players? Or is it just market noise? To get a clue, we need to look at volume. And a powerful tool for this is the on-balance volume, or OBV indicator. The OBV is beautifully simple. If the price closes higher today than yesterday, today's volume is added to the OBV. If the price closes lower, today's volume is subtracted. It's a running total of volume flow. We don't care about the absolute number of the OBV, we only care about its direction. Is it trending up or down? What we're looking for is confirmation. If the price is making higher highs, we want to see the OBV making higher highs too. This suggests that positive volume is flowing in to support the price rise. It's a healthy trend. The dangerous signal, the one that can save you from a bad trade, is divergence. Imagine the price is pushing up, making a new little high on the 1-minute chart. But when you look down at your OBV indicator, it's making a lower high. That's a bearish divergence. It's a red flag. It suggests that despite the price nudging up, the volume isn't there to support it. The conviction is fading. This could be a sign that the move is exhausted and a reversal is more likely. So let's put it all together. Picture this potential setup on a Euro to US dollar 1-minute chart. The 9 EMA has crossed above the 21 EMA, and the price is now trading above both. Your bias is bullish. You're only looking for a reason to buy. The price then pulls back a few pips to touch the 21 EMA. As it does, you look at your stochastic and you see it's dipped below 20 into the oversold territory. You wait. A new candle forms, a bullish candle that closes back above the 9 EMA. At the same moment, the stochastic lines cross and start heading up out of the oversold zone. Finally, you glance at your OBV, and you see that it's been steadily trending upwards the whole time, confirming the bullish conviction. You now have 3 different instruments on your dashboard, all flashing green. The EMAs confirm the uptrend. The stochastic suggests the pullback is over and momentum is returning. The OBV shows that positive volume is supporting the move. This is what a scalper defines as a high probability entry point. It's not just a guess. It's a confluence of signals, a systematic approach to finding a small edge in the market chaos. But even with this trifecta of tools, there's a fundamental truth we have to address. All of these indicators, every single one, are lagging. They are calculated using past price data. They are, by their very nature, a look in the rearview mirror. They can tell you what just happened, but they can't predict the future with certainty. So if our high-tech toolkit is just looking backward, how do we get a better sense of what's happening on the front lines right now, in this very candle? The answer doesn't lie in another indicator. It lies in learning to read the raw language of the market itself. It lies in price action. And in the next part, we're going to decode the specific candlestick patterns and price behaviors that form the final, and perhaps most important, layer of a scalper's entry strategy. Think of each candlestick on your chart not as a static bar of data, but as a miniature story. It's a complete narrative of the battle between buyers and sellers over a specific period. Whether that's 1 minute, 5 minutes, or 15 minutes. The final shape of that candle tells you who won, who lost, how fierce the fight was, and who might have the upper hand going into the next battle. This is the language of price action. To read this language, you first need to understand its alphabet. Every candle has 2 main components, the body and the wicks. The body, the thick, solid part, tells you the story of the opening and closing price. If the candle is green or bullish, the price closed higher than it opened. Buyers were in control. They pushed the price up and held their ground. If the candle is red or bearish, the price closed lower than it opened. Sellers dominated that session, driving the price down. The size of the body is critical. A long, powerful body signals strong conviction. A tiny, almost non-existent body, what we call a doji, signals indecision, a stalemate between buyers and sellers. Then you have the wicks, also known as shadows or tails. These thin lines extending from the top and bottom of the body tell the story of the session's drama. They show the highest and lowest points the price reached before the candle closed. A long upper wick on a bearish candle tells you that buyers made a valiant attempt to push the price higher, but sellers overwhelmed them and slammed the price back down by the close. It's a story of a failed rally. Conversely, a long lower wick on a bullish candle tells you that sellers tried to crush the price, but buyers staged a powerful defense, refusing to let it stay down, and pushed it all the way back up. It's a story of a failed sell-off. For a scalper, these wicks are clues about exhaustion and rejection at key price levels. Now, single candles tell a story, but patterns of 2 or 3 candles together, that's a full-blown conversation. And as a scalper, you only need to be fluent in a few of the most powerful phrases. You don't need to memorize a textbook of 50 different patterns. You need to master the handful that signal a high probability shift in short-term momentum. Let's start with one of the most powerful, the engulfing candle. A bearish engulfing pattern happens when you have a green bullish candle, followed by a larger red, bearish candle whose body completely engulfs the body of the previous green candle. Think about the story this tells. In the first candle, buyers were in control, feeling confident. Then, in the very next period, sellers stepped in with such overwhelming force that they not only erased all of the buyers' gains from the previous period, but they also drove the price even lower. It's a complete and brutal takeover. It's a signal that the sentiment has dramatically shifted from bullish to bearish. The opposite is a bullish engulfing pattern, where a large green candle completely swallows the previous small red candle, signaling a powerful shift in control from sellers to buyers. When you see an engulfing pattern, it's the market screaming that a reversal is potentially underway. Next up is the pin bar, also known as a hammer or a shooting star, depending on its context. The defining feature of a pin bar is a very small body and a very long wick, at least 2 to 3 times the size of the body. Imagine the price has been trending down and reaches a key support level. Suddenly, a candle forms with a tiny body at the top and a long lower wick. This is a bullish pin bar, or a hammer. What's the story here? During that session, sellers continued their attack, pushing the price way down, deep into new lows. But then, at that key support level, a wall of buyers stepped in. They absorbed all the selling pressure and aggressively drove the price all the way back up to near where it opened. It's a story of violent rejection. It's the market drawing a line in the sand and saying, "No further." Recognizing these patterns in real time within the proper context is the skill that separates a consistently profitable scalper from someone who is just gambling on random price wiggles. It's about learning to read the moment-to-moment narrative of the market and understanding when the story is about to change its direction. We've now identified our trading location, confirmed the market bias, and with price action, we have our potential trigger for entry. We have all the information we need to form a solid trading hypothesis. But seeing the setup is only half the battle. The other half, the part that trips up 90% of traders, is execution. How do you actually enter the trade? Where precisely do you place your stop loss to protect yourself if you're wrong? And most importantly for a scalper, where do you take your profit? Knowing when to get in is one thing. Knowing when to get out is everything. We've found our signal in the noise. So how do we build this machine? How do we take the brilliant, creative analysis we did to find a trade and hand it over to a cold, calculating system of execution? It starts with defining your failure point before you even begin. This is your stop loss. A stop loss is not a suggestion. It is not a sign of weakness or an admission that you might be wrong. It is the single most important order you will ever place. It is a non-negotiable contract you make with yourself and the market that says, "This is the maximum I am willing to risk on this idea. Not 1 cent more." For a scalper, this is life and death. You're hunting for small gains, maybe 10-15 pips at a time. A single trade that runs 100 pips against you, because you didn't have a stop loss, can wipe out a week's worth of painstaking, disciplined wins. It's like being a professional boxer who wins 11 rounds on points, only to get knocked out in the 12th because he dropped his guard for 3 seconds. The stop loss is your guard. It's always up. So where do you place it? There are 3 main schools of thought here. The first is the simplest, a fixed pip or dollar amount. You might decide that on every single trade you will risk no more than 10 pips. It's beautifully simple and ruthlessly consistent. You enter a trade, and your stop loss is automatically placed 10 pips away. The downside is that it doesn't respect the market's current behavior. A 10-pip stop in a quiet, slow market might be perfectly fine, but in a volatile market right after a news release, it's like trying to cross a freeway on foot. It's just not enough room. This leads to the second and far more popular method, using market structure. Look at the chart. If you're buying, where was the most recent significant swing low? That's a level where the market previously found support. It's a logical place to assume your trade idea is invalidated if price breaks below it. So, you place your stop loss just a few pips underneath that swing low. If you're selling, you do the opposite, placing your stop just above the most recent swing high. This approach is dynamic. It adapts to the ebb and flow of the market, giving your trade a logical amount of breathing room based on actual price action, not an arbitrary number. The third method is even more adaptive, using volatility. Indicators like the average true range, or ATR, measure the recent average volatility of a currency pair. If the 14-period ATR on a 5-minute chart is, say, 5 pips, it means the price has been moving on average 5 pips per candle for the last hour or so. You could then decide to place your stop loss at a multiple of that ATR, maybe 1.5 or 2 times the ATR value away from your entry. This ensures that in quiet markets your stop is tighter, and in volatile markets it's wider, protecting you from getting stopped out by random noise. Whichever method you choose, the principle is the same. You define your maximum acceptable loss before you enter the trade. This number is the foundation of everything else. Now let's talk about the fun part, getting paid. This is your take profit order. If the stop loss is your shield, the take profit is your spear. It's the predefined point where you say, "Thank you, market," and you walk away with your winnings. For scalpers, this is just as important as the stop loss, because the enemy here isn't fear of loss, it's greed. The temptation to let a winning trade run, hoping a 10-pip gain turns into a 50. The most common way to set a take profit is by using a risk-to-reward ratio. This directly ties your potential profit to your predefined risk. Let's say you used the market structure method for your stop loss and it ended up being 10 pips away from your entry. You can then decide on a target ratio. A 1-to-1 risk-to-reward ratio would mean you set your take profit 10 pips away. A 1-to-1.5 ratio would mean a 15-pip take profit. A 1-to-2 would be a 20-pip target. For scalping, ratios between 1-to-1 and 1-to-2 are very common. Expecting much more than that on a very short-term time frame can be unrealistic and may dramatically lower your win rate, as price might often move in your favor, but not quite far enough to hit that ambitious target before reversing. The key is to find a ratio that, when combined with your strategy's historical win rate, creates a positive expectancy over time. Just like with stop losses, you can also use market structure to set profit targets. If you're buying, is there a clear level of resistance just ahead? A previous swing high? That's a logical place where sellers might step in and push the price back down. Why not place your take profit order just before that level? You're essentially selling your position to the people who are just starting to think about selling. It's a proactive, intelligent way to exit, using the market's own roadmap against it. The combination of these two orders, a hard stop loss and a firm take profit, creates the mechanical framework for your trade. You have a clearly defined floor and a clearly defined ceiling. When you place the trade, you should ideally place both of these orders at the exact same time. This is what we call a bracket order. The trade is now fully automated. It will close itself out, for either your maximum acceptable loss or your predefined profit, without you having to lift a finger. And this is where the real discipline comes in. Once those orders are set, your job as an analyst is over. You are now just a manager, and your only task is to not interfere. You do not move your stop loss further away if the trade goes against you. That's like cutting the brake lines on your car because you don't like the sound they make. It's financial suicide. You also resist the urge to snatch a tiny profit early, or to move your take profit further away because the trade is moving fast in your favor. You made a plan when you were calm, rational, and objective, looking at a clean chart. Your stop loss and take profit levels are a product of that rational mind. The person staring at the screen watching the P&L flicker between green and red is not rational. That person is emotional, flooded with dopamine and cortisol. The entire point of this mechanical process is to protect you from that emotional person. You have to trust the plan. Trust the math. Let's walk through a concrete example. Imagine the euro to US dollar is trading at 1.0850. Your strategy, based on a combination of indicators and price action, gives you a signal to go long, to buy. First, the stop loss. You look left on the chart and see a clear swing low at 1.0841. This is a solid support level. You decide to place your stop loss just beneath it, at 1.0839. This gives you a risk of 11 pips from your entry at 1.0850. You know your maximum loss on this trade is 11 pips. Second, the take profit. You've backtested your strategy and know that a 1.5 to 1 risk-to-reward ratio works well. Your risk is 11 pips. 11 multiplied by 1.5 is 16.5 pips. Let's round it to 17 pips for simplicity. So you place your take profit order at 1.0867, which is 1.0850 plus 17 pips. You enter the trade and immediately your platform has 3 active orders. Your entry at 1.0850, your stop loss at 1.0839, and your take profit at 1.0867. And now you walk away. You can minimize the chart. You can go make a cup of coffee. The trade is no longer in your hands. It is in the hands of the system you built. The outcome is now binary. You will either lose 11 pips, or you will gain 17 pips. There is no other possibility. The emotional roller coaster of should I get out now has been completely eliminated. You've replaced anxiety with arithmetic. This is how you survive. This is how you scale. This process transforms trading from a gut feel, high-stress activity into a business-like execution of a statistical edge. It's not about being right on this one trade. It's about executing the plan flawlessly over the next 100 trades. Because it's over that larger sample size that your edge, the small positive expectancy you've identified, truly reveals itself. But that edge can only manifest if it's allowed to play out, protected from emotion by the rigid, unyielding rules of your trade management system. We've defined our risk and our reward, but there's one more critical variable in this equation. How much do we actually put on the line? Position sizing is the engine that drives your returns, and getting it wrong can be catastrophic, even with a winning strategy. That's the final piece of our pre-flight checklist we need to master. So let's talk about that engine. Imagine 2 identical high-performance race cars. One is driven by a reckless amateur, the other by a seasoned professional. The amateur floors the gas pedal at all times. They might fly down the straightaways, but they spin out of control on the very first turn. The professional, however, understands the throttle. They know precisely when to apply pressure and when to ease off, navigating each turn with skill and control, ultimately finishing the race while the amateur is left in a cloud of smoke. In scalping, your position size is that throttle. It dictates your speed, your control, and your ability to stay in the race. Getting this wrong is the #1 reason why traders with potentially effective strategies still end up with a blown account. The entire goal of position sizing is to answer one question before you ever click the buy or sell button. If I am wrong on this trade, how much will I lose? Notice the question isn't, how much can I make? That comes later. Survival comes first. We achieve this by defining our risk not in dollars, not in pips, but as a small fixed percentage of our total trading capital. You'll often hear experienced traders discuss the 1% rule. This isn't a magic number, but it's a foundational concept in risk management. It means that on any single trade, you will not allow yourself to lose more than 1% of your account balance. If you have a $10,000 account, your maximum acceptable loss on one trade is $100. Period. If you have a $1,000 account, it's $10. This acts as a financial circuit breaker. It makes it mathematically difficult to wipe out your account. To blow a $10,000 account risking 1% per trade, you would need to lose 100 trades in a row. While not impossible, it's a scenario of extremely low probability. Compare that to someone risking 10% per trade. They only need 10 consecutive losses to be completely out of the game. One bad week and their trading career is over. Sticking to a small fixed percentage risk ensures your longevity. It keeps you in the race long enough for your strategy's edge to play out over time. So, how do we translate that 1% rule into an actual trade size on our platform? We need 3 key pieces of information. First, your account size and risk percentage. Second, your trade risk, which is the distance in pips from your entry point to your stop loss. And third, the pip value of the currency pair you're trading. Let's break it down with a clear hypothetical example. Let's say we have that $10,000 account, and we're sticking to our 1% risk rule. Step 1 is easy. 1% of $10,000 is $100. This is our maximum acceptable loss for this trade. It's our line in the sand. Step 2. We need to determine our trade risk in pips. This is dictated entirely by your trading strategy and the current market conditions. Let's say you've identified a scalping setup on the euro to US dollar pair. You see a perfect entry point at 1.0750. Based on your technical analysis, maybe a key support level or a moving average, You decide the logical place for your stop loss is at 1.0740. The distance between your entry, 1.0750, and your stop loss, 1.0740, is 10 pips. This is your trade-specific risk. This is how much room you're giving the market to move against you before you admit you were wrong and exit the trade. So now we know two things. We're willing to risk a maximum of $100, and our trade idea requires a 10-pip stop loss. The final piece of the puzzle is to figure out what position size makes a 10-pip move equal exactly $100. This brings us to step 3, understanding pip value. For traders in the United States, trading standard lots of any pair where the US dollar is the second or quote, currency like euro to US dollar, pound sterling to US dollar, or Australian dollar to US dollar, the math is straightforward. One standard lot, which is 100,000 units of the base currency, means that a 1-pip move is worth $10. A mini lot, which is 10,000 units, means a 1-pip move is worth $1. And a micro lot, 1,000 units, means a 1-pip move is worth 10 cents. Now we can put it all together. Our maximum dollar risk is $100. Our stop loss distance is 10 pips. To find the required value per pip, we simply divide our dollar risk by our pip risk. $100 divided by 10 pips equals $10 per pip. Since we know that for euro to US dollar, a value of $10 per pip corresponds to one standard lot, that is our correct position size. By trading one standard lot, if the trade moves against us by 10 pips and hits our stop loss, we will lose exactly $100, which is precisely our predefined 1% risk. We have perfectly aligned our trade with our risk management plan. Now, let's imagine the very next setup we see is also on euro to US dollar, but the market is a bit more volatile. Our strategy gives us an entry, but this time the technically logical place for a stop loss is 20 pips away, not 10. Does this mean we have to risk more? Absolutely not. Our maximum risk is still $100. The plan doesn't change, our position size does. We run the same calculation. $100 divided by a 20-pip stop loss equals $5 per pip. To achieve a $5 per pip value on euro to US dollar, we would trade half of a standard lot or 5 mini lots. This is the profound beauty of proper position sizing. The risk on both trades is identical, $100. Even though the second trade required a stop loss that was twice as wide. Your position size adapts to the market, but your financial risk remains constant. This is professional-level risk management. To see why this is so critical, let's revisit our two drivers, but now as two traders. Trader A, the amateur, doesn't do these calculations. He just feels like one standard lot is a good size, so he uses it for every trade. On that first 10-pip stop trade, he gets lucky. He's risking $100 or 1% just like us. But on the second trade, the one with the 20-pip stop, he again uses one standard lot. Now, his risk is 20 pips times $10 per pip, which is $200 or 2% of his account. He has doubled his risk without even realizing it. He might win a few and feel invincible, but a string of these wider stop trades going against him will cause devastating losses that are twice as large as they should be. He is driving with a faulty throttle, and a crash is inevitable. Trader B, the professional, calculates her position size for every single trade. On the 10-pip stop trade, she risks $100. On the 20-pip stop trade, she risks $100. When she wins, she wins. When she loses, the loss is always a small, controlled, and pre-calculated amount. She experiences predictable, manageable drawdowns, not catastrophic account-destroying events. Her equity curve is smoother. Her psychology is calmer. She can weather any market storm because no single trade, no single day, can ever take her out of the game. She is built for the long haul. This mathematical discipline is what separates hopeful speculators from consistent traders. It removes the guesswork and emotion from your risk. It's not the most exciting part of trading. There are no flashy indicators or secret signals here. It's the methodical behind-the-scenes work that creates the foundation for potential long-term success. It's about treating trading like a business where managing expenses, in this case losses, is just as important as generating revenue. But knowing the formula and having the discipline to apply it every single time without fail are two different things. The math is simple. The psychology behind executing it flawlessly, especially when you're on a losing streak and feel tempted to double up to win it back, or when you're on a winning streak and feel invincible, that is the real challenge. And that mental game, the battle fought not on the charts, but between your ears, is where most traders truly face their greatest test. This internal battlefield is where the concepts of discipline, patience, and emotional control stop being abstract ideas and become the very tools you use to survive. In the high-speed world of scalping, this battle is amplified 100 times over. You don't have hours to calm down after a bad trade. You have seconds. You don't have a day to analyze a mistake. You have to do it in the space between one click and the next. So let's dissect this mental game. Think of your brain as having two competing executives. You have the calm, analytical, logical executive, your prefrontal cortex. This is the part of you that developed the trading plan, that backtested the strategy, that calculated the risk-to-reward ratios. This is the CEO who has the long-term vision for the company, your trading account. But then you have another executive. This one is ancient, powerful, and incredibly fast. It's your emotional core, the limbic system. It doesn't care about pips or percentages. It cares about fear, greed, hope, and regret. It's the executive in charge of immediate survival, the one that screams, danger, when you see red on your screen, and more when you see green. In normal life, these two systems work together. But in the world of scalping, they are often at war. The lightning-fast signals from the charts can easily bypass your logical CEO and go straight to the emotional one. And when your emotional brain is at the controls, your carefully crafted trading plan goes right out the window. Let's walk through a common scenario. Imagine you sit down for the New York session. You're fresh, you've done your analysis, and you're ready. Your strategy gives you a signal on the euro to US dollar pair. You take the trade. It's a textbook setup. Within 90 seconds, price moves in your favor, hits your take profit, and you've banked a solid 10 pips. Perfect start. A few minutes later, another signal. You enter and boom, another quick win. Then a third. You're 3 for 3. At this point, a subtle but powerful chemical process is happening in your brain. Each win releases a little hit of dopamine, the neurotransmitter associated with reward and pleasure. Feels good. Feels really good. This is where the first demon appears. Overconfidence. Your logical brain says, stick to the plan. The risk parameters are there for a reason. But your emotional brain, high on dopamine, says, we're on fire. We can't lose. Let's increase the position size on the next one. Let's make some real money. So, on the fourth trade, you double your lot size. The setup looks similar, but maybe it's not quite as perfect. Maybe the volume is a little lower, the momentum a little weaker. But you ignore those subtle cues because the feeling of being right is overwhelming. You enter the trade. Price immediately stalls. It chops back and forth. A knot forms in your stomach. Then, in a single brutal candle, it reverses and smashes through your stop loss. Now, because you doubled your size, that one loss didn't just wipe out your last win. It wiped out all 3 wins from the morning and put you in the negative for the day. The dopamine rush is gone, replaced by a surge of cortisol and adrenaline. The pleasure is gone, replaced by a hot, stinging anger. And here comes the second demon, a far more dangerous one. Revenge trading. Your emotional brain is now screaming. It's not a logical assessment of a probabilistic outcome. It's a personal insult. Feels like the market took your money, and you want it back. Now, your logical CEO is trying to get a word in. Wait for a high probability setup. Follow the rules. This is just a statistical loss. But the emotional executive has hijacked the system. It's yelling, get back in. We can't end the day down. Find another trade, any trade. So you do. You see a flicker of movement and you jump in with no real setup, no confirmation. You're not trading your strategy anymore. You're just gambling, clicking buttons out of pure frustration. That trade, unsurprisingly, also loses. Now you're in a deeper hole. The anger mixes with a new feeling. Desperation. You start seeing patterns that aren't there. You start widening your stop loss, hoping a losing trade will turn around. You break every single rule in your plan, not because you don't know them, but because you are no longer in control. Your emotions are. This is the tilt. The state where a trader is emotionally compromised and makes a series of irrational decisions, often leading to a blown account. This cycle is the single greatest destroyer of aspiring traders. It's not the strategy that fails, it's the psychology. The market is a master at exploiting these deeply ingrained human tendencies. So how do you fight back? How do you keep the logical CEO in charge? It requires building a mental fortress, a set of non-negotiable rules and habits designed specifically to protect you from yourself. First is the concept of a circuit breaker. Just like the stock market has mechanisms to halt trading during a panic, you need personal ones. A common and highly effective rule is the 3 strikes rule. If you have 3 consecutive losing trades, you are done. You close the platform. You walk away. Not for 10 minutes. Maybe for an hour, maybe for the rest of the day. This physically removes you from the environment where you are making bad decisions and breaks the emotional feedback loop. Another circuit breaker could be a maximum daily loss. If your account drops by a predetermined percentage, say 2%, your day is over. Period. No exceptions. This prevents a bad day from becoming a catastrophic one. Second is the mandatory use of a detailed trading journal. And I don't just mean writing down your entry, exit, and profit or loss. You must also log your psychological state. Before you take a trade, ask yourself, why am I entering this trade? Is it a valid setup according to my plan? Or am I feeling impatient? Am I bored? Am I trying to make back money from a previous loss? And after the trade is closed, you log the outcome and how you feel about it. Were you calm, anxious, elated? This practice of self-observation builds a crucial skill, self-awareness. You start to recognize your emotional triggers before they hijack your decision-making. Over time, you'll see patterns. You might notice you always trade poorly after an argument with your spouse, or that you get reckless on Friday afternoons. This journal is your data, not on the market, but on you. Third is the power of a pre-trading routine. Top performers in every field, from athletes to surgeons, have pre-performance rituals. They are not superstitious. They are designed to get them into the optimal mental state. Your pre-trading routine could involve reviewing your trading plan and your top 3 rules. It could involve 5 minutes of quiet meditation to calm your mind and detach from outside stressors. It could be looking at your long-term goals to remind yourself why you're doing this, that you're building a business, not playing a slot machine. This routine is the armor you put on before you go into battle. It centers you and puts your logical brain firmly in the command chair. Finally, you must fundamentally redefine your relationship with winning and losing. A professional trader understands that losses are not failures. They are business expenses. They are a necessary and unavoidable part of the process. Your job is not to avoid losses. Your job is to follow your plan with flawless execution. You can have a losing day while having a perfect day of execution. And you can have a winning day while trading like a complete amateur, getting lucky on bad decisions. The goal is to divorce your self-worth from the outcome of any single trade. Your focus must be on the process, not the profits. When you can take a loss that was part of your plan and feel absolutely nothing, you are on the path to mastery. When you can execute your strategy perfectly and the trade still fails, and you can simply say next, without an emotional flinch, that is the mark of a professional. This psychological fortitude isn't something you're born with. It is forged day by day, trade by trade, through discipline, awareness, and an unwavering commitment to your rules. It's about building a system that accounts for your human weaknesses and protects you from your worst instincts, allowing your best, most logical self to perform. So, how do we empower that logical self? How do we give it the tools to make superior decisions in the heat of the moment? We do it by expanding our field of vision beyond the flickering 1-minute chart. The first step in elevating from a novice to a sophisticated scalper is mastering multi-time frame analysis. Think of it this way. If you're only looking at the 1-minute chart, you're like a soldier fighting in a valley. You can see the immediate skirmishes, the rocks, the trees right in front of you. But you have no idea if you're in the path of a cavalry charge coming over the hill. The higher time frames, the 15-minute, the 1-hour, even the 4-hour, are your view from that hilltop. They provide the strategic context for your tactical 1-minute decisions. Before you even consider a scalp, you glance at the 1-hour chart. Is the price in a clear uptrend, making higher highs and higher lows? Is it grinding against a major daily resistance level? Is it trapped in a sideways consolidation? This information is pure gold. If the 1-hour chart is screaming uptrend, you can filter your 1-minute signals to only take long positions. You're now scalping with the current, not fighting against it. A beautiful buy signal on the 1-minute chart becomes infinitely more powerful if it's happening as a pullback to a key support level on the 15-minute chart. Conversely, a seemingly perfect short setup on the 1-minute chart might be a terrible idea if the price just broke out of a bullish pattern on the hourly chart. You're trying to short a freight train. By aligning your short-term entries with the larger-term market direction, you dramatically shift the probabilities in your favor. You stop getting run over by moves that seem to come from nowhere, because you can now see them forming on the horizon. This concept of context extends beyond just price charts. We have to talk about the scheduled earthquakes of the Forex market. High-impact news events. For a US-based trader, this is your home turf. Events like the non-farm payrolls report, the FOMC interest rate decisions, and CPI inflation data are the Super Bowls of the Forex world. During these releases, the market can move hundreds of pips in a matter of seconds. For a scalper, this is both a siren's call and a death trap. Many professional scalpers adopt a simple rule. They are flat, meaning they have no open positions, 30 minutes before and 30 minutes after a major red folder news event. Why? Because during that window, spreads can widen dramatically, liquidity can evaporate, and price action becomes pure unadulterated chaos. Your stop loss might not get filled at your desired price due to slippage, turning a small, calculated loss into a catastrophic one. Trying to guess the direction of the news is not trading. It's gambling on a coin flip with terrible odds. However, advanced scalpers don't just hide from the news. They understand its aftermath. Once the initial chaotic spike has occurred and the dust begins to settle, new, powerful short-term trends often emerge. The half hour or hour after a major release can offer some of the cleanest, most directional volatility of the entire day. The strategy here isn't to predict the news, but to react to the market's interpretation of it. You wait for the volatility to subside slightly, for a clear direction to be established, and then you apply your scalping techniques to trade with that new news-driven momentum. This requires patience and discipline, but it can be an environment rich with opportunity. Beyond scheduled news, we must also understand the deeper, underlying relationships between markets. This is where intermarket analysis comes into play. No currency pair exists in a vacuum. For anyone trading pairs involving the US dollar, which is most of you, the single most important chart outside of your chosen pair is the dollar index or DXY. The DXY measures the strength of the US dollar against a basket of other major currencies. If the DXY is in a strong uptrend, it creates a headwind for pairs like euro to US dollar and pound sterling to US dollar, and a tailwind for pairs like US dollar to Japanese yen and US dollar to Swiss franc. Using the DXY as a confirmation filter is a powerful professional technique. If you're looking to buy euro to US dollar, but the DXY is simultaneously breaking out to new highs, you might want to pause and reconsider. The two charts are telling you conflicting stories. These relationships extend even further. The Australian dollar is considered a commodity currency, heavily influenced by the price of raw materials like iron ore and gold. The Canadian dollar has a strong correlation with the price of crude oil, as Canada is a major oil exporter. If you're scalping US dollar to Canadian dollar and you see oil prices breaking down sharply, that could provide a strong bullish tailwind for your pair. You don't need to be an expert in commodities, but having a small window on your screen with the DXY, gold, and oil can provide an invaluable layer of confirmation and context to your Forex scalping. It helps you understand the why behind a move, not just the what. With all these layers, multi-time frame analysis, news awareness, and intermarket correlations, how do we put it all together into a coherent plan? We do it by building a playbook. A novice trader looks for one single perfect setup. A professional trader has a playbook of 3 to 5 high-probability setups that they have mastered for different market conditions. For example, your playbook might include: Number 1, the breakout pullback play. This is for trending high-volatility markets, perhaps during the London-New York session overlap. You identify a key short-term level of support or resistance. You wait for a clean, decisive break of that level. You do not chase the initial breakout. Instead, you patiently wait for the price to pull back and retest the level it just broke. Your entry is triggered when the price confirms that the old resistance is now acting as new support, or vice versa. This is a classic high-probability setup. Number 2, the range fade play. This is your setup for quieter market conditions, like the late New York or Asian session. You identify a clear, well-defined trading range. Your plan is simple. You look to sell near the top of the range and buy near the bottom, with your stop loss placed just outside the range. This is a counter-trend strategy that capitalizes on the market's tendency to revert to the mean during periods of low volatility. Number 3, the moving average crossover play. This is a momentum-based strategy. You might use 2 exponential moving averages, say a 9 EMA and a 21 EMA on your 1-minute chart. Your entry signal is when the faster EMA crosses over the slower one, but, and this is crucial, only in the direction of the trend on the 15-minute or 1-hour chart. This filters out a huge number of false signals and keeps you aligned with the bigger picture momentum. Your job is not to trade every signal. Your job is to wait for the market conditions to align with one of the plays in your playbook. This transforms your trading from a random reactive activity into a structured, patient hunt for specific, predefined opportunities. And the only way to know if your playbook is effective is through meticulous review and analysis. This is the final piece of the puzzle. At the end of every week, you must become a data scientist. You export your trading history and analyze it. Which setup from your playbook was the most profitable? Which one had the highest win rate? Did the breakout pullback play work better on euro to US dollar or pound sterling to US dollar? Was the range fade play more effective during the Asian session? This data-driven feedback loop is what separates the amateurs from the pros. It allows you to double down on what works and ruthlessly cut what doesn't. You are no longer guessing. You are systematically refining your edge based on your own performance data. This is the process of building a true professional-grade trading business, one statistically backed decision at a time. And this is where the profound shift happens. You stop being a person who tries to trade and you become the CEO of your own trading operation. Your trading plan is your business plan. Your risk management rules are your financial controls. Your trading journal is your performance analytics department. Every single trade is a business decision. Evaluate it not on its individual profit or loss, but on how well it adhered to the business plan. This is the ultimate defense against the emotional roller coaster that wipes out so many aspiring traders. Fear, greed, hope, regret. They have no place in a boardroom. They have no place in your trading. What we've spent this entire series building is not just a collection of strategies, but a framework for thinking like a professional. The truth is, the specific entry signal you use is one of the least important parts of the equation. A scalper with a mediocre strategy but elite-level discipline and risk management will, over the long run, often outperform a scalper with a supposedly perfect strategy but a gambler's mindset. Because the market is a relentless environment designed to exploit psychological weaknesses. It will test your patience by making you wait. It will test your greed by giving you a string of winners. It will test your fear by handing you a string of losses. And it will test your discipline every single second of every single day. The final boss in trading is not the market. It's the person you see in the mirror. It's the impulse to double down after a loss to make it back. It's the urge to abandon your plan after 2 trades don't work, chasing a new shiny strategy you saw online. It's the ego that prevents you from admitting a trade was a mistake and cutting the loss early. Scalping magnifies this internal battle 100-fold because of the speed and frequency of decisions. You don't have an hour to calm down and reassess. You have seconds. This is why the psychological work is non-negotiable. It is the work. Think of it like a professional athlete. A pro basketball player doesn't have a panic attack every time they miss a shot. They understand it's part of the game. They trust their training, they trust their process, and they know their performance is measured over a full season, not a single play. They review game footage, their trading journal, to see what went right and what went wrong, and they adjust for the next game. They show up, execute their plan, manage their energy, and live to play another day. Your job as a scalper is exactly the same. Show up, execute your plan, manage your risk, which is your capital and your mental energy, and ensure you are always in the game for the next session. A blown-up account is the end of your season. This brings us to the concept of mastery. You will never conquer the Forex market. It's too big, too complex, too dynamic. To believe you can is the height of arrogance, and the market has a way of humbling arrogance. Instead, the goal is to master yourself within the market environment. This journey is a marathon, not a sprint. The strategies we've discussed are starting points, not final destinations. The New York session today will not behave exactly like it did a year ago. Market volatility changes. Economic factors shift. What worked beautifully for 6 months might suddenly become less effective. The professional scalper isn't rigid. They are adaptable. They are a lifelong student of the market. They are constantly observing, testing, and refining their approach based on the data from their journal. They might notice that their trend-following strategy is performing poorly in a low volatility, range-bound market. So they might either choose to sit on their hands, a professional decision in itself, or they might switch to a range-based strategy that they have already tested and validated in their playbook for such conditions. They don't guess. They respond. They have a toolkit, not just a single hammer. Building this toolkit takes time, screen time, and a relentless dedication to review and improvement. The learning never stops. The moment you think you know it all is the moment you become most vulnerable. Finally, you must build your trading ecosystem. No one trades in a vacuum. Your environment plays a massive role in your performance. This starts with your physical setup. You need a space dedicated to trading free from distractions. Trying to scalp the euro to US dollar while answering emails, watching TV, or having family members walk in and out is a recipe for disaster. You need to be in a state of deep focus. This also includes your technological setup. A fast, reliable internet connection and a broker with lightning-fast execution are critical for scalping. A few pips of slippage on every trade can be the difference between a profitable system and a losing one. But your ecosystem is more than just your desk. It's your routine. What do you do before the market opens? A professional doesn't just roll out of bed and start clicking buttons. They have a pre-market routine. They check the economic calendar for high-impact news events relevant to their currency pairs. They identify the key support and resistance levels for the day. They review their trading plan and mentally rehearse their execution. They get into the zone. Equally important is the post-market routine. When you're done trading for the day, win or lose, you don't just shut the laptop and forget about it. This is when the real learning happens. You open your journal. You log your trades. You analyze your performance. Did you follow your plan? Where did you deviate? What were you thinking or feeling when you took that impulse trade? This self-review is brutally honest but absolutely essential. It's how you identify your psychological triggers and systematically work to overcome them. Over the course of this series, we've journeyed from the very basics of what Forex is, all the way through to the intricate mechanics and deep psychology of scalping. We've covered the structure of the US market session, identified high-probability setups, built a robust risk management framework, and now we've discussed the mindset that holds it all together. The path of a scalper is demanding. It requires speed, precision, and an unwavering commitment to discipline. It is not a path to easy money. It is a path to developing a high-performance skill. It's about building a business brick by brick, trade by trade, based on a statistical edge that you and only you can prove and refine over time. This isn't the end of your education. It's the end of the introduction. The real work begins now. It begins with taking these concepts and making them your own. It begins with opening a demo account and practicing, not to make fictional money, but to practice flawless execution of your plan. It begins with starting that trading journal from day one, tracking every decision, and building that data set that will become your most valuable asset. Go back and rewatch the parts that resonated most. Take notes. Start drafting your personal trading plan, your constitution. Define your markets, your session times, your entry signals, your exit rules, and most importantly, your risk controls. Be specific. Be objective. Create a document that you can follow without hesitation when the pressure is on. The market doesn't care about your hopes or your background. It is an impartial arena of supply and demand, but it does reward diligence. It rewards preparation, and above all, it rewards discipline. The journey is challenging, but for those who approach it with the seriousness and dedication of a true professional, the pursuit of mastery is a reward in itself. Thank you for joining me on this deep dive. Now the work begins.